Hope everyone's had a good week so far. All right, we are all set to go. So, welcome to this week's episode of Back to the Futures with me, Markets and Mayhem. We're going to be using Bookmap to analyze what's going on in the order flow of these markets. I think it's a really great tool to be able to zoom in more on what's going on in the microstructure and the order flow. So, we're going to focus on that. We're going to add a little bit of nuance as well. And we're going to talk a little bit about how options can impact that order flow and go into a few other areas of study. But I want to start with some of the basics first, really talking about the heat map itself and how Bookmap works. So let's dig in. First, a little bit about the risks involved, and there are always risks with trading and investing. My basic line of thinking with this is don't risk more than you're willing to lose. It really is that simple. When you're looking at trading or investing capital, there is a risk that you could lose everything. So size accordingly. My own thought on this is size according to the volatility of the instrument. So if you're trading something more volatile, you're going to need less size because you'll need a wider stop to make sure you don't get stopped out prematurely. That's a really important part of learning how to trade, by the way, and a lot of people miss this, but you really need to learn about position sizing. It's probably the most important part of understanding your risk management framework. And the way that I think position sizing should be defined is by the volatility of what we're trading. So the most volatile things are things like altcoins, obviously, crypto in general, it's mega beta, but even single stocks, there's a lot of individual company risk. Then you kind of go up the totem of risk a little bit, and you can look at things like industries and sector ETFs. Not nearly as much risk as an individual stock, but certainly more risk than an entire index. And then you can go all the way up to things like indices, like the S&P, like the Dow, like the Russell and the NASDAQ. And so when you climb that risk totem, you're also able to increase position size because the overall moves tend to be smaller, right? So that means you can use a tighter stop in a lot of those trading conditions. So it's about knowing your instrument, it's about knowing that regime, it's about knowing the risk that comes with those things. And a bit about me, I have been trading for 20 years. It's been a journey that has been extremely illuminating. I can't tell you how much I've learned about not just financial markets, but really myself. Trading is such a journey into your own psychology. It's one of the best ways to get to know your demons, as I was talking about yesterday, but also your strengths. And one of the things about trading that doesn't get discussed enough is that we're all wired differently. And that's really, really important to figuring out what trading style and outcomes may work best. For example, I know some folks do a lot better at scalping than they do at swing trading. And I know the opposite is true of many folks as well. And they could get into the same room and say, boy, this other group of people doesn't know how to trade at all. But really, it's a matter of personal preference and timing. We look at the markets differently, we're wired differently. I personally like a little bit of column A and B. I'm a short time frame trader in day trading, but I also like long-term trading, like swing trading, and I'm also into investing. But these are things that I had to cultivate over years. It wasn't like I just sat down in front of my computer and I could do all three automatically. It took time. And the other thing about trading is patience. You have to have it for yourself. You have to have it for the market in front of you. It's really important not to let yourself burn out overdoing things like over trading. I know that it feels like an adrenaline rush to have skin in the game, watching the price action, seeing the P&L move back and forth. But if you don't have a setup, if you don't know what your risk to reward is, if you don't know where you're stopping out, you're just gambling. And I see a lot of people doing that and thinking they're trading. And sometimes they get lucky enough that they make enough money that they think, oh boy, I've really got it figured out. You're usually just a few trades away from something bad happening in that scenario. If you don't know what you're doing and if you don't know why you're doing it, then you can't reproduce the results. As a result, you can't find consistency. Consistency is what lets you differentiate yourself from a lot of the people that eventually will blow up their accounts. That is the journey of a lot of newer traders, by the way. It's almost like a rite of passage. I'd rather it not be. I'd rather people, manage their risk and really learn these lessons from some of us veterans that have been through these battles before, made some of these mistakes, and so that you don't have to make those mistakes. And the saying goes, a wise man learns from his mistakes, a wiser man learns from the mistakes of others. Be that wiser man. Look towards other traders when they're being humble and sharing with you what didn't go so well, and learn about how you can avoid making those same mistakes. And the biggest mistakes I see people make are concentration and size. So what I mean is a lot of folks might get super excited about a theme. They get very concentrated into that theme, and that ends up hurting them if that theme, let's say, the narrative changes and it's no longer in favor. But if you had a more diversified approach, you wouldn't necessarily take the same hit. That's one example. The other example is sizing. And this applies a little better across all time frames, right? If you are too concentrated in your leverage, let's say you're running an account and you're not sizing your positions properly, you're just getting too big, every single one of those positions turns into a gamble. And often is the case when you have that much size on, you're not thinking clearly because you have so much of your account at risk. So my theory, and it's backed by studying people and looking at different types of outcomes that happen on their trading journey, is that sizing is one of the most important parts of learning how to manage your risk. So if you're sizing up and you're feeling nervous and you're not able to take your eyes away from the screen, even if you have, a stop out, which by the way, everyone should on every trade have a stop out, then you're in too much size. It's that simple. Like it's just, for example, if you're holding trades overnight and you can't sleep, you're in too much size. It really is that simple. And I know it doesn't feel quite as exciting to run lower size. Like, oh boy, this is going to take so much more work to get to whatever the fantastical outcome I'm hoping to get to is. The reality is you're much more likely to make it there if you actually have the patience for yourself to build the skills along your journey of trading, rather than hoping this next trade is the lottery ticket that somehow unlocks your future wealth and retirement. The reality is, even if you do make that home run of a trade, most people aren't going to hang on to those gains because they haven't learned the discipline. They haven't become consistent, and they're still simply gambling. And I don't want that to be you all. I don't want that to be anyone, really. I'd like to see more people succeed, and that means taking the gambling mentality away and taking a more disciplined approach. This is also, to some degree, the difference between discretionary and systematic. I think it's much more constructive to be a systematic trader. That means you're driving your trading decisions based off of data. You're developing systems that you backtest to validate their ability to work in different market conditions so that when you enter that trade, The back testing gives you the confidence to be able to hold it, and your execution becomes better because you now have the discipline to start taking that emotion away rather than just blindly guessing at price action. You have the system and the tools to be able to build on that. And this is one of the reasons that I like Bookmap a lot, because it shows the data in no uncertain terms. It's not just backward looking moving averages and looking at volume profile, which I do believe has a lot of value, but it's also looking right into the order flow itself, where there's liquidity on offer, where it's transacted, what kind of orders. We can layer in nuance like the SPX options visualizer to see where some of those flows are going in the options complex and have a more complete picture of what's moving the market, allowing us to take a more data-informed, systematic approach. So let's talk about this week's pivots. I'm going to share these out on social as well. You're welcome to take a screenshot of these. You could see they were pretty darn decisive so far. Yesterday's rally stopped pretty much right at that ES pivot as well. So I'm just sharing these out on social now. And these pivots are pretty interesting. They're generated by looking at a variety of different variables, including transactional volume, price action over multiple time frames to discern where there are key decision levels in the market. So with the S&P 500, we're looking at 6848.24, should be 25, my apologies for the typo, and for NQ 25403.25. Now, these are levels that tend to be decisive in terms of where I want to be bullish or bearish. I'll be much more bullish above these pivots. I'll be looking for more longs even on a swing time frame, and let me show you why. So here's a chart of the S&P 500. This is our pivots chart from the Traderade Discord, and this shows how these pivots are applied on a longer time frame chart. This particular level has been pretty decisive, both to the upside and downside. It looks like we're in to test it today, and in doing so, it could be pretty interesting to see if we get a move that is decisive above or below it for that continuation. And I'm also going to go between some other charts while we're trading the market today and looking at some of the live order flow to show you it from a few different angles, including these pivots. But the thing I wanted to draw your attention to is just the battle that has happened at this level and how decisive it can be when we break above or below it. So these are areas that I feel like we're going to take time looking at our charts and defining manually. Why not be able to automate some of that to save some time? And that's what the whole purpose of these pivots is, really just to save us time in charting so that we have data defined levels that we can use to make more informed trading decisions. And we could see how this lower pivot, for example, during that October trade tension swoon ended up being pretty decisive. And it ended up that a trend buy signal ultimately fired off when that was our low. You could also see the exhaustive volume down there. These are delta bars, by the way. So these are volume bars on Motive Wave. I use the same on Bookmap that show not just the total volume, it shows which side was the aggressor. That's what delta is all about when we're looking at order flow. And you can see on that swoon, sellers got incredibly aggressive on a really big move that looked pretty exhaustive. And so you had the pivot to watch, basically taking a mental note, hey, if we can break above there, this likely turns into a buy. And the next decision zone, the next battle was the 21-day exponential moving average. That is a really key level to watch, whether you're a day trader or a swing trader. The 21 EMA is a really important level to watch to be able to see at a glance the health of the trend. Below it, Usually you see some room for volatility or continuation lower, and above it, your trend starts to become more healthy and you have a better chance of an advance. And you can see when we had a more decisive break above the EMA 21 with a bullish fair value gap, that led to continuation that took us to a new all-time high. So it's that confluence. You got above the pivot, you got above the EMA 21, you took us above some of the levels that we were consolidating and fighting over earlier in the week with that bullish fair value gap. And that's what allowed us to take the market to a new high. We have a similar pattern starting to set up here. We're breaking above the EMA 21. On that, we had a bullish fair value gap. And now we are testing that pivot. Sorry about that, folks. So that's the next thing to really take into consideration is this 6848.25 level into today and the rest of the trading week. It could be a bit of a battleground today. It certainly has been overall overnight. So that's something to take into consideration when we're trading this, that this could be an area we bump into repeatedly, but the more you test a level, the more likely it is to break. So if we continue to push to this level and we see a few more rejections, that's fine. As long as we're sort of accepting these higher prices and ultimately break above, then you get that effect that is like a beach ball underwater. You're going to see some pretty juicy continuation. And the overall trend structure of this chart is bullish. We have broken back above the EMA 21. We've stayed above the Ichimoku cloud for this entire run from the April lows. As soon as we recovered, we really didn't look back. The Ichimoku cloud, for those that don't look at it, is a great way to look at long-term momentum. So, you might use a 100-day or a 50-day or a 200-day. That's all fine. And in fact, on Friday, we very convincingly tested the 50-day during this move lower. That was another thing that happened on Friday's trading action that was really interesting to see. The way that we tested the 50-day, we closed above it. Of course, there was some news over the weekend, but ultimately that test, that technical validation of that level was something else that helped with this market's continuation higher. So I feel like we have a similar setup that we had back in October. Of course, it's not quite as much volatility to compress, but it's still, I think, a good setup to continue to make a new all-time high. And it looks like around 7,000 or higher is likely where that move would cap out. And the reason I say that is because if we look at where the SPX options activity has been, the big wall of calls is up there at 7,000 SPX, which is about 70.25 or so in ES terms. And you can see that call wall up here, 70.24. I was off by one tick. So there you go. There's that call wall. That's my ultimate target for this move, for its completion. And if you think about it, even though it's been pretty sloppy, it is still a decent uptrend. You get a higher high, higher low, higher high, higher low. Now we're looking for that next higher high. So let's talk a little bit about some of the deals we have going on. If you'd like to get up to 40% off of Bookmap, you can visit traderade.com/bookmap. Scroll down to the special offers at traderade.com/bookmap, and you can grab your own copy. And with that out of the way, we're going to dive in, talk a little bit more about what's going on in these markets using Bookmap. Take a look underneath the surface here. First, let's talk about that overnight battle. So we've talked about 68.48 as being a key level to watch as a pivot today, and really for the rest of this week. Look at that battleground overnight around that level. And once we gave it up, we definitely had a little bit more momentum to the downside. So I think this level is going to be one that we're going to want to keep an eye on through today's trading session. I think it will be an overhead battleground level. Also of note, overnight, a lot of buying happened, and even into yesterday's trading around this, let's call it 68.56 to 68.57.50. There's a pretty good buy side delta there. So those buyers right now, offsides, They would love to see this come back up and above the point of control. If we can break above the point of control here, I think you get a lot juicier upside continuation. So that's why we're looking at that big bump out on the delta, about 7,300 contracts on the buy side from the SVP. That's another level of implied overhead supply, because you have folks that are probably, to some degree, some of them are saying, hey, if I get back up here and I'm break even, I'll just take my profit right here. You won't believe how common that is, by the way. People that get underwater on trades, there's been many studies on this. I've seen it play out. I've even done it myself, where you're in a trade, you're underwater, and you're like, you know what? At this point, I don't even want to make money. I just want to get out break even. That's it. That is such a common thing, that you have these kind of what you could call break even levels up here around the point of control. That's implied supply, because all those people that came and bought at that higher level, there's a chunk of them that are like, you know what, I'm okay just getting out even. So that's why you look at those levels as potential supply overhead. And we've got it marked out with the point of control, which I think you should put on your Bookmap charts. Having the point of control and having VWAP, which is this white horizontal line under SVP, those are also levels that can be actionable. And again, my whole way of looking at trading is driven by confluence. I want to see confluence from various different indications to give me greater confidence that these levels are important, that these levels that we're testing or breaking above have multiple different areas of being validated, because then they become even more actionable. Confidence through confluence takes out the guesswork. It makes it more systematic when you're trading the price action, because we're not just saying, oh, number go up, hit buy, number go down, hit sell. Like, again, some folks can do okay at that, but if it feels like you're guessing, you're gambling. And if you're gambling, you don't know why you're making money. And if you don't know why you're making money, you can't be consistent. And if you can't be consistent, you're not going to make it. That's the chain of reasoning. It's so important. I can't really overstate it. If you don't know why you're making money, you're not going to be able to be consistent. And if you can't be consistent, you're not really trading, you're just gambling. And I'd really love to see much more traders than gamblers, because traders are the ones that are going to run their operations like a business. That means we're just buying and selling inventory and capturing a positive spread as often as we can. The other thing that I think is super important for everyone, once you have a system, journal your trades. What's a system without a record to keep you accountable? You have to journal those trades so that you know whether your system is actually working, so that you can figure out which trades work and which ones don't, so that you can start to determine what kind of trader you are and lean into that approach. Journaling gives you the accountability that lets you become a better trader over time. It sounds like work, because it is. Good trading involves a lot of study and hard work to get better. If you're serious about doing this long term, you've got to get serious about putting in the work. And what I like to say is, pretty much anyone can become a successful trader, but not many people want to put in the work. It's been dressed up as, oh, this is lower effort. You just put money in this option and you make all this, 10,000% return, and then you retire. The reality is that that's not how it works. And if you do get lucky like that, and it's not because you're trading derived by a systems approach, you're likely to lose that money. So the key point is, learn about yourself so that you can determine what approach works best for the markets in front of you. So you can determine what assets, time frames, risk thresholds, and systems work to improve your consistency. So we are just less than 3 minutes away from the market open. It's a pretty data light day here on November 11th, 2025. We've got Trump speaking at 11 p.m. Or I'm sorry, 11 a.m. And that's it. It's Trump speaking at 11 on 11/11 for the Veterans Day ceremony. And we can see just this move prior to the market open, we got almost right up to our pivot and rejected. So again, This is a decision zone. There is supply up there. We're going to have to work our way through it. But the more we test up there, the more likely it is that level ultimately breaks and we can continue moving higher. Ultimately to around 7,024 is what I'd look for on a break above our weekly pivot, which for those who hadn't tuned in yet, that's 6824. I'm sorry, 6848.25. So that weekly pivot is 6848.25. A break above, building some acceptance, particularly on a closing basis, opens up 7,024 as an upside target for ES and 7,000 in SPX. That's where we are right now. You know, this is an unstoppable kind of market. And the reason I say that is every time there's potential for the market to fall on its face and for sellers to really grind lower, they fumble. There's often a headline, there's often something else that diminishes volatility and perceived risk that causes the market to recover. That's a pattern we can pretty much rely on. Even when it came down to the threat of the government shutdown or tariffs against China or any of these other things, you'll notice they get resolved before they become a big problem for the market. That's not a coincidence. That's by design. And those dips that we're getting in these volatility episodes so far have been juicy buying opportunities. We talked a little bit about that on my social media feed on Friday. I said, hey, look, if the 50-day moving average is able to hold today, I'm bullish going into next week. It held. And look at what yesterday did. Yes, there were obviously headlines involved, but I don't think that the headlines are in and of itself what led us higher. I think this administration has become a lot more sensitive to the stock market. Trump talks about it all the time, and he really wants to see more all-time highs. He's even said as much. He's told us as much. So who are we as little fish swimming in the wake of big sharks and whales to try to guess or question? We just follow the momentum. The markets are open. We're challenging that pivot level right off the open here. $68.48.25. We're seeing a challenge of that level pretty much right off the opening drive. I'm going to show you that on this other chart here. We have it on my pivots chart. You can see that we're just right grinding up against that pivot on the open. We are above the BGL. We've had the last bullish fair value gap. That was the last fair value gap we had, showing some buyer aggression. So overall, making another test here. We are seeing some buying aggression coming in, leading to selling aggression, much larger selling aggression at this large red delta bubble, and a bit of a sell side stop out. These were sellers having to buy 110 contracts on that move higher. Overall, buyers still seem to be in control here, but sellers are trying to step in and taper this move. Now I'm going to go around, look for questions and so on and so forth here. And if anyone has any questions, let me know. I'm looking at several different areas, so it can sometimes take me a little while to get back to them. So Marion asks, what are key level of SPX options visualizer and what is the reaction to this level? So right now we're reacting to my pivot, which is based more on where volume was transacting. If we look at the key levels from the SPX options visualizer, we can see on screen here, we've got a vol trigger at about 68.24. If we did break below that, you'd likely see downside continuation intensify. That was also where the most active put strike was yesterday. You can also look at the two most active calls yesterday and get a sense as to one reason why the market was so explosive to the upside. It was more than a 2-to-1 ratio between calls and puts. The two most active calls really taking the way. This is one of the reasons the SPX options visualizer can be very helpful to understanding what's driving the flow and to give you price targets to the upside or downside. Yesterday, when you had that 2-to-1 top two calls to top two puts activity, that gave you a very strong sense as to A, we're going higher, and B, here are the levels that people are targeting. And having that information in advance of the move, well, for us traders, that's usually pretty darn priceless. So that's what we looked at yesterday. Today, when the flows start to come in and we have enough to really visualize them, I'll show you them on screen. We're looking probably in the next 15-20 minutes for that to come through. And then to the upside here, we've got key 3 plus. That is a level of call derived resistance. And just below that, key 2 plus, another level of call derived resistance. And then, we can go quite a bit further here, all the way up to that call wall, where I've said this is likely where this move ends if we're able to build acceptance above the 6848.25 pivot. So hopefully that helps, Marion. Let me know if you have any follow-on questions. If you're enjoying the feed, hit that like and subscribe button. I'm on the YouTube for Bookmap. I'm on my YouTube. I'm also on X, Substack, Kick, Twitch, and the Discord for Bookmap. And feel free to ask any questions you might have about what you're seeing on screen or any charts you might want to check out or any questions about Bookmap itself. We're always happy to help. And you can see that level, that pivot level really is chunky overhead resistance. This is such a decisive level to watch, the 6848.25. Let's take a look at the NASDAQ here. Pretty similar look here. Now, the pivot for the NASDAQ has already been overtaken. That was 25,403.25. So the NASDAQ showing a bit of relative strength versus the S&P. That is overall a good thing. The NASDAQ has been a leadership area of the market, although today we are seeing some of the NASDAQ stocks struggle a bit. NVIDIA down 2%, Oracle down 2.5%. On the other side of it, you've got Apple up 0.5%, Broadcom up 0.75%. So we'll see how that balances out. It is a day where that rotation continues, however, into safer parts of the market. You've got a bid in healthcare, a bid in some of the consumer defensive stocks. You've even got a bid in energy and also in real estate. And that rotation is something we talked about a bit last week. Let's switch over back to the S&P. Still watching that 6848.25 pivot as our major resistance level. We've had about 6 minutes of opening range here. It's about a 10 handle, 11 handle opening range. So not bad, but I'd love to see it more than 15 handles. That gives us a sense that it could be more of a dynamic day. And if you hear the word handle and you're like, what is he referring to? That's just points. It's old trader lingo for points on the S&P, which traders also often call the SPOOs. And we get some decent headlines out of China earlier this morning. One of them was China is willing to work with the U.S. for a stable global supply chain. The subtext there is making sure that rare earths don't become so unavailable that it causes global supply chain disruptions. That's ultimately a good thing. We also got Redbook year over year earlier, showed an increase of 5.9% consumer spending over the prior year. Some of that's obviously due to inflation. Things are going up in price, but this is about twice the rate of inflation. So it shows there is some real increase in consumer spend. A lot of that's the top 10% of income earners, which make up about half of spending, believe it or not. And so far, the high of the day here is pretty much at our weekly pivot. So for the time being, it's been paying off to get up to that level and fade or re-offer. But I do feel like ultimately, especially if the flow agrees, and we'll see that shortly, and I'll talk about it as we do, ultimately, I think we move higher from here. The broader structure suggests it, and let's just take a look at that again. And we can see how often we've touched that pivot and how we're coiling up for another move quite possibly to break above it. But here we are. Here's the lower pivot on the NASDAQ. Here's the upper pivot that we're testing. So the NASDAQ has its own pivot to try to take out as resistance. You can see it has been a formidable area of resistance. 4 tests so far. I think ultimately, however, the NASDAQ is also likely to break above. You can see it has a similar pattern as the S&P, a constructive trend structure of lower highs, or I'm sorry, of higher lows and higher highs. So there's the April low, make a higher high, higher low, higher high, higher low just now. Looks like we're set to make a new all-time high off that trend structure. And similar with the S&P, you have that pattern of higher lows and higher highs, and we just made a higher low. It looks like as long as we can grind above that 68.48.25 pivot, we're set to make a higher high up to about 70.24 where we meet that wall of calls. And we are just continuing to challenge that pivot level. That is the decision zone for now. You could take a look at the same on the NASDAQ. We're further away from its upper pivot here. And there is some passive buying. So what you're seeing on screen with this green diamond logo with 200 is 200 lots bought from a passive buy. That is an iceberg. So you could see that pop, and then it looks like someone took off just a little bit less just after that move. But icebergs right now, net positive 229. So just a little bit of nibbling into the weakness here when we have these moves lower. Tracking that order flow is really helpful from my experience, seeing the icebergs and stops. And you can contextualize the icebergs as generally larger trading desks that are using passive orders. An iceberg is an order that is designed to not show full size. So I use them when I'm trading less liquid stocks. I use them when I'm trading options because by their very nature, they tend to be less liquid on a lot of instruments. And that can be helpful because if you're moving enough size that the order book shifts as soon as you put your limit order in, then you're scaring the order book. So imagine if you're one of these big guys and you've got thousands of contracts to move. You can't easily just put that in the book. Often when you do, it has an effect on price action. Price will often run away from really big orders. So instead, what you do is you hide your size. Say, I need to move 5,000 lots of S&P. Okay, maybe I'll break it up to chunks of 250 and do 20 turns. So that's what an iceberg is. You're moving larger size than what you're advertising. And as soon as that initial lot of the order is filled, like for me, let's say if I was doing that 5,000 in 250 chunks, as soon as that first 250 moves, I get kicked back to the back of the order queue, and the next 250 is available if price gets to it and no one's ahead of me, and there's enough liquidity to fill that order. So icebergs have the advantage of hiding your size, but the disadvantage of not necessarily filling that order as quickly. But for a lot of these larger trading desks, seeing that iceberg order flow is helpful because it can give you a sense as to where they are on this. Are they buying into weakness? Are they selling into weakness? Are they buying into strength? Are they selling into strength? That can help to qualify the overall mood of the larger participants. And they can move the market, even though the iceberg orders by their nature are not really designed. It's really the opposite. You want to try to have the least price impact. When you see a lot of passive order flow, the rest of the market starts to sniff that out too. So for example, just as an example, let's say you get a violent stop run to the downside. And you start to see massive amounts of passive buying, thousands and thousands of iceberg buys coming in as price action slows to the downside and starts to reverse. That can be your early indication that the weak hands got flushed out, that stop run showing you that happening in real time, and that some of the more liquid, larger desks are starting to come in and get interested and nibble. So seeing those two contrasting outcomes can also be helpful to be able to decide in that moment, hey, maybe I'll start building along and swimming with the big fish. You could see they're buying thousands and thousands and thousands of lots. I'll join them on that. So that's one of the areas where you can get a trade set up from that two-way event where you get the more price sensitive, less liquid traders getting stopped out in a violent move lower, and you see the larger trading desks building positions into that or even covering positions, but usually it's a combination. That can be an opportunity to take that long and look for the flow to define some of those exit prices. So for example, if in that scenario, on that move higher, you could see the most active call strikes are picking up volume, they're starting to outpace the put, then I would be looking at that most active call strike as my exit level. So, we don't have it yet today in that it's still working on building that flow, but we'll start to take a look at that options flow. Yesterday, it was pretty clear that those higher option strikes were going to be the upward target because they were trading 2-to-1 versus the most active puts. So that's the kind of order flow and that setup you'd be looking for, at least 30%, 40% more on the most active calls versus the most active puts to give you a sense that they have a flow advantage. Now, why do we watch options flow? What makes it important? What makes it important is that it's the biggest driver of price discovery. The S&P 500 index options, about 55 to 60% of them expire the same day. About 80% of them expire within a week. So it's a lot of near dated flow. But the other part of it that makes it even more noteworthy is that it trades about 1.3 trillion with a T of notional every day. It's the biggest options complex on earth. People talk about Nvidia options trading a lot or Tesla options trading a lot. It's generally not even close to the S&P 500. And 1.3 trillion in notional versus the futures, which trade several hundred billion across all the equity futures contracts combined for the US indices. The tail really wags the dog. Options are in control of the show here. They are the biggest driver. They're not the only driver, but they are the biggest driver, and they're often in the driver's seat as a result for price discovery. Because when someone buys, let's say, these really active call contracts on SPX, what happens? Dealer has to hedge their delta, because if they have to pay out the contract, they're not going to pay it out from their pocket. They're not going to take a loss. They're going to hedge. Okay, so they'll buy S&P futures contracts to delta hedge that call, which means that if the call pays off, the person who bought it is being paid from the gains on those futures contracts. Well, that gives options buyers asymmetry, adds to the leverage of how they can impact price discovery in the broader market. This is why having a view on the options levels and the flow can be really important to understanding more about what's driving price and where it may go. And that's why I built the SPX options visualizer, and that's why it pairs so well with Bookmap. Because Bookmap's giving you the overall liquidity heat map. It's showing you where there's interest. It allows us to find these really important confluence levels in what's on bid and offer, where there's been transacting in the session volume profile, where there's interest in the icebergs, and so on. And then we can find some confluence with the SPX options visualizer and add to our confidence about how some of these levels really do matter. For example, we can see there is some confluence between the most active put strikes where we are right now and some of these areas on bid for the market. We can also see right now that the most active call strike is outpacing both the hot and warm put together. We got 2,000 trading on that most active call strike, just up there around, in ES terms, 69.24, in SPX terms, 6,900. So that's already an early indication that we may have some room for continuation higher. Again, we're challenging the 6848.25 pivot. We've got to break above that, build some acceptance. To me, acceptance is trading above that price for at least 5 minutes. The longer, the better. And then we've got room up to that hot call. Obviously, there are some potential resistance levels along the way, including this bump out at the SVP that has confluence with the point of control in key 2 plus. This would be the next level of resistance to watch if we're able to break above that pivot. Then we've got key 3, a weaker resistance zone that has confluence with the warm call. And then we've got that most active call strike. And key 1 plus, just buy it, which is another formidable area of options driven resistance. Just a little bit less resistance than the call wall at 7024 or 7000 SPX. So overall, just watching for that break above the pivot, and it may not even end up happening today, but the more we test it, the more likely it is to happen. And that, I think, sets up for a pretty nice release of upside volatility. Checking in on the flow, puts are starting to pick up here. We're going to zoom out a little bit so I can show you what I mean, but we are seeing some of that put flow start to pick up quite a bit, actually. So a little bit of a change in the trading dynamics. Now we've got the hot put at combined volume twice that of the hot call and warm call. So that is to say the most active put strike has 2 times as much volume as the 2 most active call strikes. And we're seeing that having a pull effect on price, getting us into these lower areas of the bid. So we're rejecting the pivot and we're moving lower. We've always got to be prepared for a two-sided trading type of situation. So the way we're going to draw the line in the sand here is we're looking at VWAP under SVP as well as these resting bids. This should be a strong support area. If it's not, then I do become a bit more concerned about the way this could trade. We could get a break to the downside. That would also be a break below the 20-minute opening range, which for all intents and purposes hasn't been too bad. About a 12 handle opening range, maybe about 11 handle opening range. It's not too bad. Still sets us up for a less dynamic trading day than what I would prefer. And the other thing to take into consideration is on Tuesdays, for whatever reason, double breaks are even more common. A double break means you could get a break below the bottom of the opening range that ultimately resolves with a break above the top of the opening range. Wouldn't that be interesting? It happens more often than one might think. So I've been asked, do I compute a weekly expected move that some compute using the options chain? I mean, I feel like the short-term VIX is kind of made for that. So I don't know that I have to recreate the math behind it. You can always look at that short-term VIX to get a better idea. But if you want to do that, it's certainly something you can endeavor to do. I just don't know that the math needs to be replicated there. I like to look personally, just to give a sense as to how I qualify vol. I like to look back and forward. So I like to look back at realized volatility over 30 days and forward at implied volatility over 30 days. That to me gives me a better sense as to where volatility might go because I'm incorporating the historic volatility and the expected volatility. And then using those two, I'm able to better define how I'm going to stop out of a trade if it's not working. Because if it exceeds what the expectations in historic volatility outcomes have been, then obviously I'm wrong. right? That is to say, if you get a move that's greater than what's implied and it's to the downside in the wrong direction, I don't want to be in that trade anymore, just as one example. And we are getting a bit of a continuation. We just made a slight new low. Let's zoom out and look at that options activity again. It is pretty heavy on the put, so we're getting some hedging programs coming through earlier today, and it's pulling some liquidity out of this market. That is certainly looking like that's part of what's going on. So I jokingly posted this morning a meme saying, "Good morning, chat. Ready for some disappointing trading conditions?" I'm sorry for that being prophetic. I truly am. But seeing this pivot and the way we're challenging it and just sort of, back and forth, that's kind of what gave me the inspiration for it. It could be a day like this. Finally getting another push here. We haven't broken above or below the range really in any decisive way. So, really looking for one or the other to get some sense as to whether we might get lucky enough to get a trend day. Seems like a big ask, but I do want to be pretty disciplined. I'm not just going to take a trade for the sake of taking the trade. I want to take a trade where the risk to reward is favorable and where I've had some degree of being able to backtest the potential outcomes. And so far today, I haven't seen a whole lot of that. The only thing that we talked about earlier was just sort of fading the pivot rejections. That's been a trade that could work if you want to really scalp the heck out of this market. You might be able to get 8 to 10 points on those. But now we're finally testing the pivot and not rejecting. Look at this. Big aggression coming in. Sell stop run, 337 contracts. This is what I like to see. Let's see if we can actually break above. It'll be all the more impressive with that put flow because you can see there's real buying coming in underneath and driving liquidity into this market. We've now broken above the 68.48.25 pivot here. Like to see some acceptance built above. Let's take a look at this from just one other point of view. And I'm just going to switch charts to the ES chart. You could see we're finally making a more decisive break above that pivot. Let's hope this doesn't end up being a fake out. That would be a fade right there. If this doesn't actually end up holding, that kind of look above fake would be a nice fade. But let's see what happens. I'm open to all possibilities here. So far, it's looking relatively real. We're going to switch that 5 minute candle in just under 2 minutes here. And that's going to make this move look a little bit more convincing, closing a 5 minute candle above it, above the 6848.25 pivot. Remember, that brings us closer to this bump out in the session volume profile we talked about earlier, which has confluence with the point of control. That is the next implied level of supply. So you have folks that bought earlier that might be okay with just getting out break even. And we have seen the hot call roll lower a bit here, taking 68.74 now. Confluence with key 2 plus. And we were able to close that last 5 minute candle above the weekly pivot. Now we're retesting. What I'd really love to see is a retest, validation, and then a higher low built right around here. That would be great. That would suggest we've got room for upside continuation. Folks, if you want to learn more about Traderade, visit us on the web at www.traderade.com to learn more about the SPX options visualizer. Visit traderade.com/SPX and to get up to 40% off of Bookmap for your first billing period. Visit traderade.com/bookmap. As always, I hope today's episode of Back to the Futures with me, Markets and Mayhem, was helpful to you and your trading process. If you have any questions, you're always welcome to reach out to me by email, mayhem@traderade.com. I'm available for one-on-one coaching if you want to learn more about my approach to markets, polish up your own systems or otherwise. And of course, check out my socials, Mayhem 4 Markets on Twitter and YouTube. That's Mayhem, the number 4 Markets on YouTube and Twitter. I'll be back next week, Tuesday at 9 a.m. Eastern for the next episode of Back to the Futures. I'll look forward to catching you all then. Have a great rest of your week.